Well, hello and welcome, Providence Financial friends and family. I'm Anthony Sicaro, founder and president of Providence Financial and Insurance Services located in the heart of Los Angeles and Woodland Hills, California. I'm also host of the Providence Financial Retirement Show that airs every Saturday on AM 870. KRL Lays the Answer, and several months ago we started a podcast. So if you're not following us on our podcast, feel free to do that. You can search for the Providence Financial Retirement Show on your favorite podcast player, or go to providencefinancialpodcast.com. But that's a great way for you to continue to stay in touch with us. And there are shows on the podcast that you can only listen to on the podcast. So please feel free to follow us. Now, over the last year, it's been a whirlwind, right? About a year ago, the pandemic was announced and the world started shutting down, and we shut our office down so that for the last year, we've been working from home. Now, many of you might be saying, what? I had no idea you guys were working from home. Well, we put out a video about that, and our goal was so that you would have no idea that we were working from home. But that's the way it's been. We've had one person in the office full time, so she's had all 4,000 square feet to herself for the most part, and the rest of us have come in kind of sporadically. And there's been team members of mine that haven't shown up for months, and they're going to have to remember how to get here because we are opening up again next week. We're going to be full-time back in the office, everybody. Doesn't mean anything to you, just more of a quick announcement. But the reason that I wanted to do this video is because so much has happened in the last year. I thought I would take 5 or 10 minutes and do a quick recap of some of the major things that have happened and particularly how it affects you. Now, some of you are laughing at me now saying 5 or 10 minutes. Yeah, right. This is Anthony speaking. Okay, maybe you got me. Maybe it's not more than 5 or 10 minutes. But I'm going to try and keep it as brief as possible because we have done videos on every single one of these little points that I'm going to recap for you. And you can go back and watch those videos. And this is kind of like the nutshell version of what we've been talking about over the last year. And most of you are pretty good at watching my videos. And I thank you for that. We get hundreds of views on all the videos that we put out. And of course, we get comments and you guys thank us. Now, some of you, have contacted me and said, well, how come we didn't tell you? Well, the reality is we've told you, you just haven't watched the videos. And it really gets to be frustrating for me when I put out these videos and then you guys don't watch them. Again, that doesn't apply to most of you. And of course, if you don't normally watch my videos, you're probably not seeing this one anyway. But this is how I communicate with you. If you don't follow us on YouTube, go to our homepage, Providence Financial Inc., click on the YouTube button in the upper right corner, click follow, and then that way when I put something out, you'll get it instantly. Whereas if you're not following us, it might take you a couple days to get it because then we're gonna put it out to our e-newsletter list, and you might get it a day or two later. So let's do a quick recap. First of all, Sound Income Strategies, the firm that we use to manage our clients' portfolios behind the scenes, did a webinar that a lot of you have watched, hundreds of you have watched. It was a 2-hour and 45-minute webinar that was done almost 3 weeks ago. And that webinar is called Sound Income Strategies Webinar. So if you go onto our YouTube channel, Sound Income Strategies Webinar, I'm going to encourage you to watch it. It was long, 2 hours and 45 minutes. It wasn't the most stimulating material in the world. But you had David Scranton, who's the chief financial analyst and the owner of that company, and 2 of his other chief financial analysts talking about what they think is going to happen in the next year. They talk about things like compression spreads, which I want to hit on in this video. They talk about why the markets are up, where we think the markets are going to go, why the yields are down. Something else I want to touch on in this video, give you the recap version. So they covered a lot of stuff. Folks, these are the guys that are managing your money. You want to know what they're thinking. You want to know what they say. And again, sometimes some of you will call me and you'll have a whole list of questions. And the only thing I can do is say, go watch that video because all these questions were answered in the video. And I don't want you to miss an opportunity just because you didn't take a little bit of time to watch the video. So I take the management of your portfolios seriously, and you need to do the same thing too. This is not time for complacency, as well. And I appreciate your trust, but you have a role in this as well as far as your portfolio also. So go back and watch that webinar for sure. Again, it's called Sound Income Strategies Webinar. That's what it's called. It was done about 3 weeks ago. Watch that. But I do want to recap a couple of things. One of the questions that I've gotten recently from several of you is, why would I want to put some money in the stock market now with the market at record levels? Well, Sound Income Strategies in the webinar answers that question, but I'm going to give you the brief overview of why it may make sense to do some of that. But before we do that, let's go back to the beginning and let's remind all of you, that the whole point of us investing your money is for income. Every single one of you know that we focus on income, and every single one of you understand and love the idea that you would rather get some type of consistent income from your portfolios with a lot less risk than the market, than really trying to put all your money in the market and mutual funds and cross your fingers and toes and hope that everything grows. When you have income, you can count on some things, you can do some planning. When you have growth oriented items, it becomes a gas. So you have all bought us because we focus on income. And yet income over the last year has gone down. Yields have come down because the 10-year treasury has gone down. The 10-year treasury at one point last year, I think, hit like 0.3 or 0.35. I mean, these are just extremely low levels. That just means that if you bought a 10-year treasury, you committed yourself for 10 years to get a 0.35% rate of return for 10 years. That's just absurd, but the reality is when people have no confidence in the economy, they're willing to lock their money up for 10 years at 0.35% because it's better than losing it. And so when people lose confidence in the economy, the treasury rates go down. The 10-year treasury, but that's kind of the benchmark, the 10-year treasury goes down. And when that goes down, so does the entire world of fixed income investments. And the reason is because that 10-year treasury is the benchmark, and that 10-year treasury is considered to be the risk-free rate of return. So if you could get 0.35% for 10 years with no risk, then why would you ever invest for 0.35% for 10 years if there was some level of risk? So every investment has to offer you more than the risk-free rate of return in order to attract you, in order to entice you to be able to invest with them and not with the 10-year treasury. So the reality is that's, when the 10-year treasury comes down, it allows everything else to come down because it's so low that they don't have to, these other companies or other entities that are issuing their fixed income investments don't have to offer as much. If the 10-year treasury is offering 1.5% risk-free, let's say, as it is now, then they might have to offer 2 or 3% to entice you. But if the 10-year treasury is offering 0.35%, then they might only have to offer 0.75% or 1% or 2% to entice you. So everything kind of follows the 10-year treasury. It's almost like a police car on the freeway. The police car on the freeway kind of acts like a pace car, right? No one wants to pass him. 10-year treasury is the same thing. It's got everything kind of follows that 10-year treasury. So when it goes down, income comes down, dividends come down, yields come down for the most part. When it goes up, yields go up. Now, yields and the value of your portfolio act opposite of each other. So when interest rates come down, values of portfolios tend to go up when you're dealing with fixed income. When interest rates go up, values of portfolios tend to come down. So as the 10-year treasury's gone down, and then as it's come back up again, you've seen that fluctuation in your portfolio, albeit very small, not a huge fluctuation, but you've seen that fluctuation. But now what's happened is at the beginning of the year, the 10-year treasury was around 0.8. Now it's it hit 1.6. When I looked at it this morning, it was 1.54. So it's almost double in the last 3 months, 2.5 months, right? Almost double. That's unheard of. That's just phenomenal. That's phenomenal growth. And the reason is because people are getting more confident in what's going on in the economy, what's going on in the country. When people like what's going on, when people are confident, then that 10-year treasury is going to increase. That's what happens because people demand a higher rate to put their money safe. If you're confident in what's going on, why would you lock your money up at 0.8%? You want more than that. And so the reality is as the 10-year treasury has gone up, what that means is because yields act opposite of portfolios, is some of your portfolios have come down a little bit, but very little. Matter of fact, I've had no questions about this at all. It's been such a minor change, generally between 1% and 3% from what we've seen. And yet if you owned a 10-year treasury at the beginning of the year, and you held that 10-year treasury, that 10-year treasury has come down by, I believe it's like 5.7%, somewhere around 5.7%. Don't quote me on that. It's definitely over 5%. but somewhere around 5.7%. So what that means is if you bought a 10-year treasury because you thought it was safe, now you want to sell it, you're going to lose 5.7% on that 10-year treasury. Because remember, the only way to guarantee that you're going to get your money back is to hold it for 10 years, to hold it for that maturity time. You sell it before then, all bets are off. And in this situation, you would have lost 5.7%. So the fact that you could lose 5.7% on that, but our clients' portfolios are maybe down 1 to 3, and I think there's only a couple at 3. I think most of you are 1. And the reality is, if you're reinvesting your income, you're not down at all. You didn't even notice any of this. You might be, looking at me going, "What do you mean down? Didn't even know." And we haven't had any questions because it's just part of the normal fluctuation. But we have gotten some questions about how the 10-year treasury has affected everything, and the fact that it's down by 5%. And I want to share with you something that Eric Lutton talked about in the Sound Income Strategies webinar. What he talked about is preferred stocks and other fixed income investments that you guys own acting as a natural softener for when the 10-year treasury goes up. And the funny thing is he did this 3 weeks ago, and the 10-year treasury shot up double within or up by like 50% in the next week. He looked like a genius. I mean, really, and he knows what he's doing. He is a genius, I know, but it just made him look like a genius, because what happens is if the 10-year treasury doubles, you might think that your portfolio is going to come down a lot, but that's not really the way it works, because the interest rates go up. When they go up, it's because people have confidence. So what happens is they don't require as much of a spread to take on some risk as they do in a time period where maybe the economy is not so good and where they don't have that level of confidence. And that's something that's important to understand in the fixed income world, is this thing called credit spreads. So let's say that at 0.35%, let's say at 0.8%, where the 10-year treasury was at the beginning of the year, at 0.8%, that someone who was going to buy a single A bond, might require 4%. Actually, let's just say 4.8%. So really, there's a 4% spread, right? The difference between the 0.8 you could get risk-free and the 4.8 you could get with a good quality bond. There's a 4% spread there. Well, as people get more confident and as the 10-year treasury starts to go up, the 4% on your bond may not change at all. And if the 10-year treasury goes to say 1.8, hasn't gone there yet, but if it goes to say 1.8, well, now there's only a 3% spread. But because people are more confident, investors are willing to buy that particular bond where there's only a 3% spread, whereas prior they required a 4% spread. So the more confident, so the less confident people are, the more of a spread that they require from fixed income to the safe-free, the risk-free rate of return. And the more confident people get, the risk-free rate of return comes up, but they don't require it. This doesn't go up in proportion. Okay, the spread that you're getting doesn't go up in proportion. So if people are not confident, that spread might be here, but when the 10-year treasury goes up, that spread's going to narrow. What does that mean for you? It's kind of a natural shock absorber. It's like hitting a pothole. If you got good shocks on your car, it absorbs that, right? And this is what happens in the fixed income world. As interest rates start to go up, that spread lowers, so it starts to absorb it. What that means to you is that you don't see a lot of movement in your portfolio, and I think that's an important concept to understand, is that this is what's happening. Eric talked about it on the Sound Income Strategies webinar. Go watch that, because he get into more detail about that, and then exactly what he talked about happened within the next week and a half. And again, he looked like a genius. But I want to that's the 5-minute nutshell version of how credit spreads have affected things. And again, the 10-year treasury has just doubled just phenomenally. Let me look at my notes and see, because I think we're almost done. A few things I want to do, a few other things I want to talk about. Hopefully that answers the question about credit spreads. I do want to take a few minutes and answer another question that we've gotten several times, really just in the last week, and that is, do I want to buy equities now with the market as high as it is at this point, or why should I? Well, we don't know what's going to happen, right? No matter what that you hear on the news, no matter what I say, we don't know what's going to happen. In a year from now, I will tell you exactly what you should have done today. It's just investing in hindsight's a piece of cake. But going forward is it's a tough situation. We don't know what's going to happen. But in that Sound Income Strategies webinar, they talked about the fact that for the next year, it looks like we're going to have smooth sailing in the market. Matter of fact, the market is going to shoot up. There's a lot of people out there in the world, a lot of analysts and experts that think the Dow's going to hit $40,000. 40,000 points, not dollars, but hit 40,000. And the way that it's going, I'm in that camp. I think that that's very possible. Now, a couple years ago, we didn't have an option to give you that we have now. Okay, and that option is that we didn't have an equity portfolio, and rates have been coming down for the last 10 years. So, so what's happened is Sound Income Strategies has been trying to position themselves to take advantage of the equity markets, and they wound up looking for almost a year for the right candidate who was an equity expert, a stock expert, and they found him in the person of Eric Byrich, and he was one of the individuals that spoke at the Sound Income Strategies webinar that I've been referring you to. And he's an equity analyst that for over 30 years has been been working with value stocks in Wall Street. And he's beaten the S&P 500 multiple times. This guy is, I'm going to say, second to none. I have just seen his track record and so on. And he speaks in Sound Income Strategies. And if you want to learn more about him, go to soundincomestrategies.com and just look under the team members and find Eric Byrich. And matter of fact, you can read all the bios of all the different analysts that are there and the support staff and everything else. But go find Eric Byrich. This guy is a value-based investor, and all that means is that he's good at finding companies with dividends. Okay, and he doesn't just, when he's searching for a company to put in a portfolio, he doesn't just go to motleyfool.com and come up with a stock and 10 minutes later decide to put it in the portfolio. This guy researches a stock for weeks. He calls all of his analyst friends. He calls investors relations. He calls his analyst friends again, and then trying to find every pothole. Every potential downside, and then he does that, and then he puts this stock in a portfolio. And he's developed a portfolio that right now is yielding 4.5% return, 4.5% yield. That's roughly, and that yield changes as the stock market changes, but it's between 4 and 4.5% is where it's consistently been. Guys, that's huge. You're not going to find a dividend portfolio out there, a dividend mutual fund that's giving you 4 to 4.5% income. That's monstrous. And there are certain companies that are out there that were doing that, and every now and then I will have someone come in that's yielding 5 or 6%, and then it turns out that they got all their money in AT&T or some other high-yielding stock, and there's no diversification. So what Eric has done is he's built a portfolio where the yield is between 4 and 4.5%, and no more than 1, maximum 2% in any one position. So you're extremely diversified, and you have this yield. That's huge. And why does that become important? Because we focus on income. We're an income firm. You know our beliefs. If you're in retirement, you should not have to spend down your principal, live off your interest and dividends, protect your principal, eat the eggs and leave those chickens alone, right? You've heard me talk about that. Bottom line is we focus on income. And before having an income stock portfolio, we were limited to the universe of options that pay income that are not stocks. But because interest rates have been coming down, because Sound Income Strategies is always one step ahead of the game, that's one thing I love about them. The reality is they hired Eric before this whole pandemic started, and it's become very important because the yields have come down in general. So now, for the last year or so, we've had the ability to offer you not only the ability to put some money into stocks, but the ability to put some money into stocks that are paying a high dividend. So it's no longer a growth or income play. It's a potential for growth. And by the way, we get the income coming in too. So if you can still live off your dividends, and we don't care about the share price. The only time we care about the share price is if you have to sell shares in order to get your income. So this really, the income portfolio allows you to have your cake and eat it too. So one thing that Sound Income Strategies has done to offset, to mitigate the lower yields, is in fact to add this equity portfolio in. So now you can have now you can still get your income, but then you've got potential for growth as well. And I'm going to suggest that a good half of you, because you've watched the webinar, because you've seen me in previous videos, because in previous videos I've talked about this before, and I've invited those of you who watch the video, if you want to put some money into these equities, call us. And I'm going to say probably half of you have put anywhere between 10 and 30% into equities. Would I recommend that you just change your entire philosophy and dump all your money into equities? No, I wouldn't recommend that at all. I think we still need to be cautious. and the market still has a potential to crash and go down. There's still a lot of negatives out there. But the reality is that a lot of you want to put something in there to help try to offset the lower yields that we've been seeing. Right now, 4 to 4.5% yield on the income investments is kind of where we are, whereas a year ago was 4.5 to 5. So we've come down about 0.5%. And this is a good way to offset that. So if you want to put some money into this, then call me. Let me know. We'll schedule a client review. We'll talk about the option to do that, and so on. So that's one thing that Sound Income Strategies has done is they've now hired Eric. They've built a high value portfolio, a high dividend portfolio, so you can have your cake and eat it too. Now, by the way, one of the reasons that this is also beneficial is it almost doesn't matter which way the market goes for you to benefit from this, because if the market continues to grow and you've got some money in equities, you're going to be glad you have some money in equities. But here, check this out. If the market goes down, and we know that if it goes down, it's going to recover. We don't know how long it's going to be. The last drop was, 37% down in 37 days, and 10 months later it was back to normal. Most of the times a drop happens in 1 to 2 years, and then it usually takes 3 or 4 years to come back. The reality is if we have that kind of drop in recovery again, and you're reinvesting your dividends, well, that's benefit for you, because as the stock market drops, because you've got dividends in your portfolio, we can reinvest those. So when it comes back, you come out smelling like a rose. If you're reinvesting your dividends, the market drop is a benefit for you. Now, if you're spending your income and you're not reinvesting, well, then you don't care about the market drop. As long as you're living off dividends and interest, you don't care about the drop because you're not having to sell shares. It doesn't matter. If you're collecting rent off your real estate, off a rental property you own, you don't care what the value of the rental property is. You just care that your rent check's on time. So as long as you're getting the dividends, who cares what the value is? So the fact that you've got dividend paying stock acts as a buffer for the stock market as well. So if the market goes up, you win. If the market goes down, you win. And so that's one of the reasons why adding some equities to your portfolio, now that we have a higher dividend equity portfolio, makes a lot of sense. And that's one of the reasons why a lot of you guys have done that. So if you want to do that, call me. If you want to have a conversation about it, call me. But that's one thing that Sound Income Strategies has done to mitigate or to offset the lower yields, the lower income. The second thing they've done is they've added REITs to their portfolio. REITs is real estate investment trust. When you buy a REIT, technically you're buying a stock in a company that owns real estate. But this is more of a growth and income play. Because the value of the stock is based on the underlying value of the real estate. So as real estate grows in values, so should your share price. So you've got potential to be investing in real estate, but without being a landlord. So Sound Income Strategies has added REITs to their portfolio. And the real estate investment trust, because they own real estate, the real estate have tenants. The tenants are going to pay leases to the owners of the real estate. And leases generally have what's called an escalator clause, which means that every year they adjust by some degree. A lot of leases just adjust by 3% every single year, go up that inflation escalator because of the way that they work. So when you invest in a REIT, you've got the potential growth for real estate, or the value of the share price, but you've also got the income. And most of our REITs right now are 5% plus as far as the yield is concerned. So it's pretty good. Now, if you don't know what you're doing, REITs is a dangerous space. So the analysts at Sound Income Strategies have analyzed, if not all the REITs out there, certainly most of the REITs out there that are even worth considering. And they've come up with 10 REITs, and they're not putting more than 1% in any one particular REIT. So for our clients and for those of you that have already given us permission to add REITs to your portfolio, you're going to see that you don't have more than 10% in your portfolio and no more than 1% in any particular company. So we're diversifying away that risk. And there are some REITs you want to stay away from, like maybe shopping mall REITs. Probably not a good space to be in, but there's other REITs that make sense, like maybe nursing home REITs or hospital REITs or stuff like that. So you got to know what you're doing if you're in that REIT space. But that's a potential inflation adjuster as well, too. Now, also, the equity portfolio with the dividends is also a potential inflation adjuster as well, too. And that's because good companies tend to increase their dividends over time. And again, because these companies because it's stock, these companies have the potential to grow in value as well, too. So REITs and the dividend paying equity are good inflation adjusters as well, too. And by adding both of these to your portfolio, even to some small degree, maybe just 10 or 20 or 30%, it gives your portfolio a little boost so that you're not stuck in that 4 to 4.5% range you have potential for a little more growth. And that's a question that we've gotten over the time. We've had so many of you that have called us and said, thank you for adding this to your portfolio. We kind of felt like income was the right thing, but we've seen the market grow. We haven't been able to participate in that. We don't want to gamble our money, but it'd be nice to have something there. This is a way for you to do that. And we're going to keep growing. We're going to keep adding new offerings as it makes sense, but we're going to do it right. This is doing it right. If you are already with Sound Income Strategies with me, and Sound Income Strategies is managing your money, and you want to add some equities, email me, send me or call my office, and I'm more than happy to meet you, have a phone conversation with you, and so on. Now, be a little patient with me, because every time I put a video like this, bottom line is I get flooded with calls. So just be patient with me as far as being able to get to you and so on, but we'll have that conversation. Now, some of you are still not with Sound Income Strategies, and I'm not going to take any reason to talk about why some are and some aren't. That's beyond the scope of this video, but I would like every one of you to be with Sound Income Strategies. If you are not, if I'm still managing your portfolio as I was doing in the early days, and you're still having me manage your portfolio, we need to switch you to Sound Income Strategies. Please call me, and we'll go ahead and do that, and you'll be able to take advantage of them, which is certainly going to be a bigger benefit for you as well too. So I think that's it. Let me see if there's anything else. No, that pretty much covers it. Really appreciate your business. Thank you for your trust. Again, call me if you want to make that change to adding more equities. Call me if you're not with Sound Income Strategy yet. Let's make that change. Or if you haven't anything else, you haven't heard from us for a while, I would hope that's not the case. But anything else, feel free to call me. And again, appreciate your trust in business. Thank you. God bless.